Thank you for this very kind invitation to give the keynote at the Bank of Korea conference. It's a great honor to be here. What I would like to do today is to address perhaps one of the important questions that is on the minds of central banks, which is the global economy headed for a repeat of the stagflation of the 1970s? And on the surface, at least, there are some causes for concern. Partly, it's going to do with commodity price increases. And there are other risk factors as well, not least the external environment, exchange rates, and domestic debt. What I'd like to do today is to give you the highlights from two recent BIS bulletins, one on commodity markets and one on household debt and the housing market. So let's first look at some of the facts, especially with the war in Ukraine. We're now very conscious of the market share, of the production share of Russia and Ukraine in commodities. And it's not only energy commodities like gas and oil, but especially food. And there are also industrial metals for which Russia and Ukraine have a large production share. So here, Russia is in pink and Ukraine is in blue. If we compare the recent price rises to the price rises in the 1970s, so the pink is the first oil shock of 1973, and then the blue is the second shock in the late 70s. We see that at least in terms of the scale of the price increase, the recent energy increase here in yellow is relatively small. However, what we see is that both in food and in industrial metals, the rise has been larger than at least some of the episodes in the 1970s. On the other hand, we are in a much more favorable inflation environment compared to what we had in the 1970s. So here in pink, we see the increase. We see the inflation measured as of December 1973 in pink, and we're measuring time both backwards and forwards, and zero is December 1973. When the oil shock hit in December 1973, inflation was already high. It reflected the breakdown of the Bretton Woods international monetary arrangement and the steady increase in inflation, at least from the mid-1960s. And in blue, we see that in the second oil shock, inflation was already high. What we're seeing now in yellow is the pickup in inflation from levels that were very low. So in terms of levels, we find ourselves in a much more favorable environment. And there is a very important structural difference between now and the 1970s, which is that the world is much less dependent on oil due to the decreasing energy intensity of GDP. So energy intensity is measured in terms of the energy use. So here there's so we're measuring this in terms of megajoules to real GDP. So we normalize GDP, and then we just measure the energy use per real dollar of GDP. And energy intensity has fallen around 40% since the late 1970s here in the red line. And it has been much more so for oil itself here, which is in the blue line. It's less apparent for gas, but the message here is that energy efficiency and structural changes in the economy mean that the world is much less dependent on oil. If we look at the sources, the energy share from the 1960s onwards, we again see in pink that the energy dependence on oil has fallen from around 50% in the 1970s to around 30% now. And I'd like to just flick through a few of the other structural changes, and I will be very quick here because this is more in terms of the underlying structural changes and also some of the engineering aspects. But it is noticeable, for example, that the decreasing dependence on oil has been accelerated by the greater reduction in costs of renewable energy. And this is so even in the last 10 years or so. If we go back to 2010 and we looked at the IEA forecast for the electricity generated using renewables, that was the blue dotted line. And every 5 years or so, we are now upgrading that chart so that compared to where the projections were in 2010, the use of renewables has been really a success story. The same is true if we look at the cost of renewables. And here the dark gray line, the dark gray band, is the range of costs of fossil fuels. Now we see that for solar, for wind, the costs have really come right down. Now this, of course, doesn't mean that the proportion of electricity generated by renewables has become a very substantial part. In some regions, it has become substantial, as we'll see, especially in Europe. But in the bigger picture, the proportion taken up by renewables has been really rather small. So this is really for the next few decades rather than something that's going to be relevant for the short term. If we look at the energy use globally by source, it's in the order of so oil first, then gas, and coal is still important, especially in China. And then everything else is a very small proportion. Even the so even nuclear and hydro are very small. So China is still very reliant on coal, as we see here in yellow. But if we look at Europe, we see that the other category at the very top, this is mostly renewables, is now taking a bigger proportion. So now in Europe, at least, we see renewables making a bigger impact. And what about Korea? Korea, I think it's similar in Europe in some respects, although the proportion of renewables is small, although it is growing very rapidly. The bottom line is that the structural changes in the economy mean that the dependence on oil has really fallen quite dramatically over recent decades. So when we look at the impact of commodity market disruptions on the economy, we now have to bear in mind the various channels. And so rather than simply looking at pictures, what we can do is to try and estimate the impact using an empirical model. And what I'll show you is the result of a very parsimonious model that we have in-house at the BIS. And we're going to look at the impact of commodity markets through 3 channels. So the first is the direct impact on inflation. And that in turn is consisting of the direct impact because the cost of fuel enters directly in the consumption basket. There is also the indirect impact by raising the costs of other goods, especially manufactured goods. But rather than simply looking at the price impact, I think it's also important to look at the quantities because we have to distinguish a price increase in fuel that is purely due to the financialization of commodities and a real impact that is due to, let's say, a reduction in supply disruptions due to war, due to other supply bottlenecks. So we'll also look at the increase in price distinguished by whether it's accompanied by a decline in quantity or whether it's simply a price shock. And finally, because this is a global model, it also allows us to distinguish between commodity producers and commodity importers and see the relative impact so that we can see how much the gains from the exporters might compensate at the global level the losses that are incurred by the importers. So let me just give a very quick description of the empirical model itself, and you can refer to the bulletin annex for the details. What the authors did in this bulletin is to run a two-step process. The key variable here is the vector which looks at the change in production, the change in global industrial production, and the change in the price itself. So that's for the energy block. For agricultural commodities, we look at also the similar sort of first order changes, the first differences, and through using this kind of time series model, we identify the shocks. So we look at the deviations from forecasts and define the deviations as the shocks underlying the model. And in particular, what we want to do is to distinguish the oil shock that has both a supply decrease as well as a price increase, and distinguish the pure price shocks, which have to do with the financialization, where you have no change in the quantity, but only a change in the price. And the same thing is also true of the agricultural commodities. So that's the first step. We identify the shock through a time series model. And then we put these variables into a VAR, and we trace the impact of the various shocks through to the underlying macro variables. So to GDP, to consumption, investment, inflation, and profits, etc. So here are some of the results. When we look at growth, so in particular, when we look at global GDP, it turns out that it's the oil price shock. It's the price increase that is accompanied by a decrease in the production. This is what really causes the largest decline in global GDP. It's around half a percentage point of global GDP. If the price increase, if the 10% rise in oil prices is accompanied by a decline in the quantity. When it is not accompanied by a decline in quantity, it's much smaller. It's less than 20 basis points. If we compare the purely oil price shock with the agricultural price shock, it's the agricultural price shock which has a bigger impact on global GDP. And we can then see what the distributional impact is by tracing the respective impulse response functions. And here we see that it's mainly the importers who are losing. So importer impulse responses are here on the left-hand column, and the exporters here on the right-hand column. We see that it's the importers who lose, but the gain of the exporters is not large enough to compensate in a global sense for the decline in the loss by the importers. But the message here is it's very important to keep track of the quantities as well as the prices, and food is going to be a very important consideration when we think about the shock to global GDP. Now, what about the transmission mechanism? So how do we think about the intermediate variables? And because we are running a VAR, we can actually track the various channels through which the GDP is affected. And what we find is that all the components of GDP are pretty much affected. And here we see that wages and consumption, they're all significant and negative for the importers. The bars with the diagonal lines, these are the insignificant effects measured at 8 quarters out. But what we see is that there is a tremendous redistribution towards the profit of the producing countries, of the firms in the producing countries. And if we look at the impact on inflation, we see again that it's the agricultural price shock that is much larger. So that has a much bigger impact on inflation, especially for the importers, but also for the exporters as well. And we also see that if it's an oil price shock, there is also a feed through into the inflation, both for importers and exporters. What's really interesting is the final column, which is that for an oil supply shock, the sign of the impact is negative, even for oil importers. It's insignificant, as we see in the hashed diagonal lines, but it's negative. And this is a very interesting result, we think. And when we look at the impulse responses, we get a sense of why it's negative. It's feeding through the negative impact on growth. So initially, the impact is positive, as we see in the top panel. But because of the hit on GDP, that feeds through into lower inflation at the 8 quarter horizon. It's insignificant because we see that 0 is within the confidence interval. But an oil quantity shock is ultimately going to be contractionary, and therefore it will pull down inflation, according to this model. If we look at the spillover to core inflation, we see that the spillover effects are really quite large, both for both for oil as well as for food. So I think what this does suggest is that even though commodity prices will affect headline inflation in the first instance, if you leave it to feed in through to the economy as a whole, we can expect core inflation also to be affected a few quarters down the road. Now, we find ourselves in a very challenging monetary policy backdrop, and so let me just finish with just a few words on that. And then I will wrap up just to see where we are as a whole. Now, when we look at where we are in terms of real policy rates, the picture is in some ways quite similar to the first oil shock. So the current episode here is in yellow. The red is the first oil shock, and the blue is the second oil shock. Real rates, as we know, are negative, and they're actually deeply negative, even with the recent beginning of the rate hikes in the advanced economies. And if we were to look at this in any kind of standard Taylor rule type of framework, we would be deviating quite a lot on the downside as well. Now, this is somewhat concerning if we just take it at face value. But given the special circumstances, perhaps there are some extenuating circumstances that would actually paint a much more benign picture. And we have to weigh these two sides of the same story. But it is important for us to know that the starting point is that real rates are very negative, and we have a long way to go if we are thinking of raising real rates anywhere close to 0 or to some kind of Taylor rule formula. And what we see here in terms of the projections into 23 and the forecast for 22 here is that in both the advanced economies and in emerging economies, pretty much everyone is forecasting a decline in inflation for 2023. I think this picture is a very good illustration of some of the special circumstances that have impacted the global economy due to the pandemic. I think it's although the word transitory has now become less popular, and Jay Powell has said, it's time to banish the term. I think what this picture shows is that in terms of the forecast, at least, there is a great deal of belief that current inflation is indeed going to prove transitory. Because if we look at the red diamonds, which is the forecast for 22, and the yellow diamonds, the yellow circles, which is the forecast for next year, we see that pretty much everyone is expecting inflation to come down quite rapidly. And so when we look at this chart, it's perhaps overly pessimistic in that although real rates are highly negative, and in some respects we are tracking the trajectory of the first oil shock, there are so many special circumstances with the pandemic that if we draw on all the special circumstances that we understand is very important in the current episode, inflation is very likely to come down. The question is how quickly and to what level. And I think here, this is where that chart I showed you on the pass-through to core inflation is going to be very important. And because of the inertia of inflation expectations and wage behavior, and in particular the labor market, we can imagine that labor market conditions and inflation expectations will eventually react to realized inflation if we leave it to remain high for too long. And one particular challenge in this episode is the fact that we have come through a very unusual episode in the housing market. So I'm now going to the bulletin on the housing market that we put out some weeks ago. When we compare the recent episode on house prices to a standard downturn, typically in nominal terms and in real terms, house prices decline during a downturn. The most recent downturn was very special in that we saw in pretty much every jurisdiction, house prices continue to go up, as we see here in the dotted line. This is also true especially on household credit growth. Again, typically when we have a downturn, household credit growth declines, and in particular if we compare it with the general credit as well, we typically see a decline in credit. That was not the case in the COVID recession, both in terms of the general rates, but also in terms of household credit. We see that there was an increase in household debt. Another very important development which has developed over time, and this is a fairly recent phenomenon, is that we see a very important role for a global factor in property prices. So we know that financial markets are influenced very much by a common global factor because we know that there is a risk-taking channel which governs risk-taking in financial markets and in banking. So we're very used to thinking about that and the way that exchange rates also co-move with the risk-taking channel. What is new in the last couple of decades, but especially most recently, is that the common factor is also very strongly evident in house prices too. And this chart, which is again from the bulletin, just shows you how much the common factor is explaining the variance in the. So this is the proportion of the variance explained by the first principal component of a number of especially small open economies. And we see that proportion of house prices explained by global conditions has really gone up. I think what this shows is that the risk-taking channel and the channel by which global conditions and exchange rates affect the domestic economy is not simply through the trade channel, it is also through financial conditions. And for that reason, when we look at the challenges up ahead, exchange rates will be a very important variable for us to bear in mind. The other thing that we've seen, especially because of the increased incidence of household debt, is that components of demand have become very sensitive to house prices themselves. And that has gradually seen this increase, especially in those small open economies that were least affected by the global financial crisis of 2008. So in the large advanced economies, the UK, the Euro area, the UK, the US, the Euro area and the UK, we saw household debt decline because these were the economies that were most affected by the global financial crisis. In countries that you see here, New Zealand, Canada, Sweden, Australia, these were countries that were less affected by the global financial crisis. We saw house prices continue to go up, household debt continue to increase over the whole period. And there, the consumption sensitivity is actually quite high. And as we know, household debt has increased both in large advanced economies that were affected by the GFC, as well as the small open economies that were less affected by the GFC. So this is showing household debt to disposable income, but the relative to GDP would show a similar trajectory. So when we look ahead and we look ahead to policy normalization, the big challenge that we face is how do we achieve a soft landing when the economy is going to be so sensitive to monetary policy actions. And this is a chart that we put in the bulletin that looks at the debt service debt service ratio. It's the debt service costs relative to total debt, and how that might change as we simulate high interest rates. And it's already quite high, but when we look at the lowest quartile of the income distribution, and in particular the most vulnerable quartile in the debt service ratio among the households, we see that the distribution of the impact is going to be quite varied across countries, but they are really substantial. And I think what we will see as policy is normalized is that debt service ratios, the debt service costs will go up. And it's going to affect those countries with floating rates, and it's going to affect the lower end of that vulnerability spectrum. So, or rather, I should say the higher end of that vulnerability spectrum. So this is going to be a very important policy issue and a very important topic for domestic debate. And this is not simply going to be a theoretical debate. not simply a monetary policy debate. It's going to be a larger policy debate within the whole economy as a whole. So if I may conclude, I think what we've seen is that the lower energy dependence and stronger policy frameworks make the repeat of the 1970s highly unlikely. I think we should put that to one side. The 1973 shock was a very special shock, and it's probably not going to be something that we will see again. However, we have seen that commodity prices do affect the economy, both through growth and through inflation. And for the various reasons that we've covered, there is a premium on restoring low inflation, bringing inflation back to target, all the while bearing in mind the very difficult and different trade-offs that we face both on the external sector, exchange rates, and household debt. So let me conclude there.